Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris milling wheat and London, UK feed wheat. Paris milling wheat. 21 weeks ago, part of my musings on the market then were thus, and I quote, "Take a look at the whole, big action, since the peak in May to date, that is May 22 to date. It is a mid-June to date, June 22, mid-June 22 to date bear channel, currently 225 to 301, which is highlighted in bright green on my daily chart. If you favour the bearish side, then these are worth considering." End of quote. This is the bright green bear channel you can see on my daily chart. Now, I added 15 weeks ago a mid-November to late December 2022 bearish shift pitch hook, but it got very ragged and I retired it. And instead I drew a more recent late December 2022, mid-February 23 bearish Andrews pitchfork, the one you can see highlighted in dark blue on my daily chart. This had done a better job of capturing the bearish angle of attack until this week, as the market looks to be ready to spend its first complete week outside this bearish pitchfork since February. Unless prices return back within its tines by this time next week, then I will likely retire it. As I said last week, and I quote, "Looking at the recent action, you can see the market is coming to a sort of a cusp, as prices reach the point of where the upper tine crosses over the lower bear channel line. And obviously one of them will have to give way." End of quote. As I said 7 weeks ago, and I further quote, "If there were to be an attempt lower in the near future, then the crossover period would likely be the worst time to do it, unless the bearish pressure was stacked high. Far better to wait till they separate their individual ways and thus their power individually is less than their current combined support." End of quote. It very much looks like the bearish pressure was not, repeat, not stacked high enough, and prices have turned up and away from the lower big bear channel line, for now at least. So what's happened this week? Well, the market has run up into a combination congestion zone between 238 to 242, which has the March 2013 high within it at 240, and a short medium moving average currently 242, entering and reinforcing this from above. Above these we have resistance, seemingly light resistance at the February 2013 high at 247, before we have a congestion band between 250 to 255, with the 2013 high at 253 within it. Now further above we have a small congestion band between 258 to 260, but what is interesting about this band is that it has the declining medium moving average within it, currently 258. The medium moving average will likely keep declining, such that you might see it enter the 250 to 255 congestion band, which is actually below that one, in the next couple of weeks. Thus the road ahead and higher is not that easy a road to travel right now, but it seems the market may be willing to try it. London, UK feed wheat. Back in January, as the market punched up through the short medium moving average, currently 188 even, up to the old previous all-time high at 238.80, we saw something interesting. This old previous all-time high capped the rise, and from mid-February down to late March, we saw a drop down through a number of supports that became resistances. They were the January low at 217.25, as well as the 2013 high at 215 even, the 2022 low at 206.5, and the March 2013 high at 205. Indeed, prices continued declining as if the market was in an area seemingly empty of significant supports. Yet there were, or at least should have been, supports slowing and halting the decline. But those that were gave way under the bearish pressure. Now these supports were in no particular order: the September 2021 low at 181.70 and the supposedly powerful 50% absolute Fibonacci line at 180.5. Now 7 weeks ago I also pointed out, and I quote, "The action also allowed me to draw a new bearish Andrews pitchfork for the very late October 2022 to February 2023 move. Initially I was not wholly wedded to this pitchfork, as neither the upper tine, that's currently at 175.45, nor the lower tine, that's currently at 143 3/4, had been tested. However, in the absence of anything else, I was minded to watch this pitchfork, and so far it has been pretty good at indicating the bearish angle of attack. End of quote. This pitchfork has continued to be excellent at showing the bearish angle of attack of the market, especially between the upper and the middle time. Middle time currently at 161.10. This leads me to another point about the bearish pressure, and this is the weekly key reversal down made 3 weeks ago. Here, unlike some of the other weak markets, we have seen a pretty good immediate follow-on lower to this weekly key reversal down, such that the middle time was being tested each of the past 2 weeks. However, in doing so, the market started approaching some significant supports below. Now, this support is not the July 2021 low at 164 even, though I would perhaps add that this market low may have actually been influenced in its construction by this support. The support is a congestion area formed over March to April 2019 between 161.95 to 165.75. I have not been sure as to how the market would treat this congestion, given how it took 2 and a bit weeks to punch down through what is now the immediate overhead resistance of the 50% absolute Fibonacci line at 180.5. But this congestion below is the next support zone, hence it should be respected. Now this leads me to my final point, and it is this. Has there been constructed here a mini reverse head and shoulder pattern, potentially a reverse head and shoulder bottom, over the last 3 weeks? This would have a neckline in the mid 177 even area. Mid 177 area I should say. I've not drawn it, but it looks ominous. You see, the upper time is now below the 50% absolute Fibonacci line and moving rapidly lower. Thus the combination of these together, the absolute Fibonacci line and the moving lower upper time, the combination of these together as a capping action is dissipating, as each individually is less resistance than the two of them combined. So if there was an opportunity to break higher, it is coming around, and real soon, if not right now. Therefore, caution on the bearish side. It might not be as strong as it was as recently as last week. However, as any technical analyst will often say, the trend is your friend, and up until this week, this bearish Andrews pitchfork has been great at showing the trend lower. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.